Hi friends, welcome to my channel Investor Rational. Markets are once again at record highs, but history shows that periods of extreme optimism often come with hidden risks. In this video, we'll examine whether current market conditions suggest a possible correction or crash in 2026 or not. So, are markets headed for a crash in 2026? We'll focus on Shiller PE ratio, Buffett indicator, and other macro signals. Note that the discussions will not be predictions but mere probabilities. Now, let's look at the current market conditions. The US stock market continues to trade near all time highs, supported by optimism around earnings growth, AI, and economic resilience. However, beneath the surface, valuations are elevated and leadership is narrow. This disconnect between price and fundamentals is where risk often begins to build. While investor sentiment remains high, concerns about overvaluation persist. Metrics like the Shiller CAPE ratio signal that current equity prices may be unsustainably inflated, raising flags about future returns. I'll come to what is Shiller CAPE ratio. What are its current levels for S&P 500 relative to historical levels later in the video. I'm sure you would have already read or heard about certain analysts suggesting that the market's current valuations are not supported by fundamental indicators. According to them, this often leads to adjustments in equity prices when the realities of economic conditions take hold. The Shiller CAPE ratio, or cyclically adjusted price to earnings ratio, is a valuation measure that adjusts the price of stocks by average earnings over the past 10 years. This approach smooths out earnings fluctuations, providing a more stable view of valuation trends. Currently, the Shiller CAPE ratio is elevated at approximately 40, significantly above its historical average of around 17 to 18, suggesting substantial overvaluation in the market. High CAPE ratios don't predict immediate crashes, but they do signal lower future returns and higher downside risk. Now, coming to the famous Buffett indicator. The Buffett indicator, which compares the total market capitalization of US stocks to the country's GDP, serves as a gauge of market valuation. Currently, this indicator is at around 220%, a level significantly above historical averages, suggesting heightened market overvaluation and increased investment risk, echoing Warren Buffett's caution against investing in overvalued markets. A ratio above 120% generally suggests that the market is overvalued. A major concern today is market concentration. A small group of mega cap stocks, often referred to as the Magnificent Seven, account for a disproportionate share of market gains. This mirrors the late 1990s when tech stocks dominated indices. Now, let's shift our focus to labor market signals. They have been in the headlines recently. The US unemployment rate has been gradually increasing, signaling potential economic weakness. An uptick in unemployment can indicate that businesses are struggling to maintain their workforce, which often foreshadows broader economic challenges. Many people are claiming it to be on account of the adoption of AI. Recent layoffs in the tech, finance, and corporate sectors highlight growing concerns about job security. Major companies are reducing their workforce, which can signal decreased confidence in future economic conditions. Many people are claiming it to be on account of the adoption of AI. Labor markets often weaken before broader economic downturns, making this an indicator worth watching closely. If one believes all the unemployment and layoff increase is not on account of AI, then there's a reason to worry. Gold and silver trading near all-time highs suggest rising demand for safe haven assets. At the same time, oil prices remain relatively subdued, pointing to weaker demand expectations. This divergence often reflects caution about future growth and rising uncertainty in financial markets. Looking back at major market downturns such as 2000 and 2008, we see recurring themes: high valuations, concentrated leadership, and strong investor confidence near market peaks. A key difference today, though, is that corporate balance sheets are generally stronger. Remember, history doesn't repeat exactly, but it often rhymes. The dot-com bubble bursted in 2000, led to a significant market downturn as overvalued tech stocks collapsed. This event highlighted the dangers of speculative investments and inflated valuations in the tech sector. The global financial crisis unfolded in the year 2008, which was triggered by the collapse of mortgage-backed securities, and it led to widespread economic downturn. This crisis exposed systemic risks and vulnerabilities within financial institutions. Today's markets show similarities with past crises such as high valuations and a concentrated market, but differ with stronger balance sheets among corporations, indicating potential resilience against economic shocks. Now, let's compare the bull case and the bear case. On the bullish side, earnings growth, technological innovation like AI, and ample liquidity could support markets longer than many expect. Accordingly, the market may continue to remain resilient in 2026. On the bearish side, extreme valuations, slowing economic momentum, and stretched sentiment increase downside risk. Slowdown in the economy may lead to potential declines, even a market crash. Even the volatility may suddenly rise in 2026 due to uncertainty. The challenge for investors is that timing market turning points is extremely difficult. From current levels, investors should expect higher volatility and potentially lower long-term returns. This is a period where diversification, risk management, and discipline matter more than chasing performance. The goal isn't to predict a crash, it's to prepare for a range of outcomes. Remember, high risk is not always similar or does not always lead to immediate crash. While current market conditions may suggest vulnerability to corrections, historical data reveals that high risk environments do not always lead to immediate crashes. Investors should focus on strategic preparation and disciplined investment practices to navigate potential volatility and capitalize on long term growth opportunities. Stay informed, stay diversified, and stay disciplined is the mantra to follow. Hope you liked this video.